Hello, I'm Julie Price, and welcome to Juniper's first quarter 2023 economic review. Thank you very much for joining me. Economic and market conditions remain challenged in the fourth quarter of 2022, concluding the year dominated by surging inflation, Russia's brutal invasion of Ukraine, and aggressive monetary tightening. Both stocks and bonds suffered unusually large losses, making 2022 the worst year for a balanced portfolio since 2008. Fortunately, there are convincing signs that an inflation downtrend is underway, and the lack of overbuilding in the most cyclical sectors of the economy suggests that any recession would likely be mild. Despite recent cooling in inflation, the Federal Reserve has stuck with its hawkish stance, reducing its balance sheet, raising the federal funds rate by a whopping 4.25% in 2022, and signaling further rate hikes ahead. This has narrowed the window for a soft landing as the economy faces strong headwinds posed by lower household savings, poor sentiment, weakness overseas, and sharp increases in both interest rates and the dollar. Not surprisingly, this has coincided with steep declines in both the stock and bond markets. However, this does leave valuations at much more reasonable levels than at the start of the year. The questions for investors are when to take advantage of these better valuations and which areas to overweight or underweight in a very complicated macro environment. In this quarter's review, we assess the performance of 2022 for the markets and economy, considering trends in economic growth, jobs, inflation, profits, the rest of the world, and the US dollar. This is followed by comments on the outlook for monetary policy. Finally, we consider the implications of all this for those investing across asset classes and highlight the importance of taking a balanced view to asset allocation after the market sell-off of 2022. Any investment strategy should start with a broad assessment of these fundamental issues. To help us out, we turn to JP Morgan's Guide to the Markets. Join me while I discuss these topics and more. Volatility was a defining feature of the markets in 2022 as higher interest rates and inflation, Russia's war in Ukraine, and recession fears sent markets tumbling. The matrix page shows a sober picture of recent performance with significant losses in both global stocks and bonds and only commodities posting significant gains. However, calmer waters should lie ahead for investors. Inflation is falling, the Fed is nearing the end of its tightening cycle, and much of the expected weakness in economic growth is already reflected in market valuations. A broadly diversified portfolio could have risen by more than 30% between the end of 2018 and the end of 2022. Even after losses this past year, many investors are well ahead of the game in their long-term plans, and after this year's global reset in valuations, they are being offered a much broader menu of investment opportunities and higher potential returns than existed a year ago. Entering the first quarter of 2023, the U.S. economy is losing economic momentum and confronting major headwinds to growth. While the U.S. consumer has been largely resilient so far, higher interest rates have weighed on home building, trade, and business investment. Following 2 consecutive quarters of negative GDP growth, real GDP grew at an annualized rate of 2.9% in the third quarter and likely grew between 1 and 3% annualized in the fourth quarter. However, growth is likely to be slow in the year ahead. In particular, high inflation is squeezing consumer wallets, cutting the personal savings rate to 2.3% and boosting credit card balances. Excess savings from the pandemic supported spending in 2022, but this stock is now drying up. Further, it is unlikely consumers will see much further aid from the federal government. Declining deficits, while positive for the long-term financial position of the U.S. government, reduce the flow of government money, particularly to low and middle income families, and this has already led to much slower growth in real consumer spending. This will become even more difficult in 2023 with the termination of the student loan moratorium. This weakness in consumption will be accompanied by slow growth or declines elsewhere. Mortgage rates have more than doubled since the start of the year, and these increases, coming hard on the heels of soaring home prices, have dashed the hopes of millions of potential home buyers. This should result in continued declines in home building, home sales, and the spending associated with setting up new households. Even after a late year sell-off, the dollar rose by roughly 9% in 2022, and this very high exchange rate, combined with weakness overseas, will likely boost imports and curtail exports, thereby dragging overall economic growth. Inventories will also likely grow more slowly going forward as companies have largely restocked shelves after pandemic-era shortages and now face reduced consumer demand. These are areas where spending could be stronger, such as new vehicle sales, as supply constraints ease, and government spending if state and local authorities can increase wage rates enough to attract limited talent. However, overall, the economy is likely to see, at best, very weak real GDP growth throughout the end of 2023, with probably a greater than 50% chance of a recession. While the economy is threatened by recession in the year ahead, the fact that it is not in recession now largely reflects unusually strong excess demand in the labor market, which has kept unemployment low and wages supported. However, the economy is now losing momentum even in the labor market. Job openings have come down and will likely fall further as businesses reel back hiring efforts in the face of slower demand and higher costs. Initial and continuing jobless claims have also begun to trend higher, although it still sits below historical averages. However, there is also a limit to how much weakness we may see in employment going forward, as U.S. businesses still face a structurally smaller labor force than prior decades. Diminished legal immigration, particularly over the course of the pandemic, and a large number of baby boomers reaching retirement have left the economy very short of workers. This will somewhat resolve itself as higher wages and a higher cost of living lure some back into the labor market. As such, the economy could still see some months of solid job growth and low unemployment, and it is quite possible that the unemployment rate will only nudge slightly higher in the year ahead. Wage growth has also moderated and will likely slow further, providing some relief to businesses and inflation. For workers, lower inflation will still help boost real wages in the year ahead. Following a spectacular 2021 in which S&P 500 operating earnings per share rose by 70%, in 2022, profits came under pressure amidst higher costs and receding demand, leading operating EPS to decline by an estimated 4% over 2022. Looking forward, consensus expectations for a double-digit gain in earnings in 2023 look too optimistic, and we expect earnings to be flat to down relative to 2022. However, the drawdown in earnings is also likely to be much less than past recessions, where history suggests earnings could decline by as much as 15 to 20%. If earnings are flat to down and a recession materializes, valuations will likely decline further. Rising costs, rather than deteriorating sales, have accounted for weakness in earnings, and pricing power should continue to differentiate winners and losers in 2023. Energy and utility companies should continue to benefit from high margins, while businesses that provide essential goods and services should be supported. Elsewhere, rising labor costs, higher interest rates, and slowing nominal sales growth should bite into profits. In addition, a much higher dollar poses headwinds for companies with overseas sales, and recession concerns could cause management to further reel in spending and investment. A recession would lead to a further decline in profits, and lower inflation tends to coincide with lower corporate profit growth, which poses an additional headwind in the year ahead. However, if we don't see a recession, this may eventually lead to less wage pressure and easier monetary policy, and it could set up a better long-term environment going forward. 2022 was undoubtedly a year of very high and rising inflation, with headline CPI inflation peaking at a 9.1% year-over-year gain in June. The good news is that there are convincing signs that a sustained inflation downtrend is underway. Most recently, consumer prices rose just 0.1% month over month in November and just 0.2% when excluding food and energy. As we show here, a modest pace of inflation has been mostly sustained over the last 5 months. Moreover, when looking at the components of inflation, the major hot spots of inflation from last year have now simmered down. After Russia's brutal invasion of Ukraine sent global commodity prices soaring in early 2022, energy prices have been declining for many months now. Further, easing supply constraints combined with lower consumer demand have allowed inflation to simmer across core goods categories. Shelter inflation remains elevated, but this reflects rent increases from the pandemic with a significant lag. JP Morgan expects shelter will soon peak and decline to reflect cooling rental markets. The remaining problem for inflation is services prices outside of shelter, which are highly correlated with market dynamics. Fortunately, easing labor market tightness should also allow for services ex shelter inflation to come down. High and rising inflation caused pain for consumers and markets in 2022, but inflation is set to ease over the next few years to much more manageable levels, whether the economy falls into recession or not. JP Morgan predicts we will see inflation at 6.5% for December, 4.4% by March, and 2.6% by the end of June 2023. One important aspect of the financial backdrop is the broad-based weakness of the global economy. Here we see the composite PMI, Purchasing Managers Index, heat map of the world, with red representing weakness across manufacturing and services sectors and green representing strength. This chart clearly shows declining momentum toward the back half of 2022. In particular, the Eurozone economies and the UK have been badly hit by higher energy prices and energy shortages due to the Ukraine war. This has led to slumps in consumer confidence and spending. Inflation has risen sharply across Europe and caused central banks to adopt more hawkish policy positions. At the start of the year, the key policy rates of the ECB, the European Central Bank, and the Bank of England were at 0 to 0.5% and 0 to 0.25% respectively. Today, they have risen to 2% and 3.5% respectively, and they are both set to move higher in the months ahead, even amidst recession risks. While growth has been slow in China in 2022, JP Morgan anticipates that 2023 will be a better year. With the easing of zero COVID policy, liquidity injections for the real estate sector, and a focus on easing geopolitical tensions, growth in China should pick up in 2023 and normalize in 2024. The US dollar soared in 2022. In nominal terms, it is close to its highest level since 2002, and in real terms, once inflation is taken into account, it is close to its highest level since 1985. The dollar's strength has been a function of weak growth overseas, geopolitical and macroeconomic uncertainty, and the Fed's particularly aggressive tightening compared to other central banks. However, this high dollar has contributed to a worsening current account deficit, now amounting to roughly 4% of GDP. Due to its lagged effects, this is likely to widen further over the next year, seriously undermining the competitiveness of U.S. manufacturing and diverting an ever-growing chunk of U.S. demand toward overseas producers. This rising dollar has also further undermined returns on international equities. In the long run, we expect economic forces to gradually drive the dollar down. In the near term, the dollar may continue to be supported amidst macroeconomic uncertainty and the Fed's hawkishness. However, we may soon see a peak in the dollar as the Federal Reserve nears the end of its tightening cycle and global central bank tightening narrows the gap in interest rate differentials. 2022 was also a year of aggressive monetary tightening, with the Fed swiftly delivering a cumulative 4.25% in rate hikes over the course of the year. Despite recent easing in the labor market and inflation, the Fed has maintained its hawkish stance on monetary policy. At its December meeting, the Federal Reserve increased the federal funds rate by a reduced pace of 0.5%, following a series of 0.75% hikes, and remained firm on its higher for longer messaging. The Fed has signaled further rate hikes ahead, with the summary of economic projections indicating a median expectation of further increases to a range of 5% to 5.25% by the end of 2023. Meanwhile, the Fed is also continuing to reduce their massive bond holdings at a maximum pace of $95 billion per month. The Fed's updated economic projections showed a somewhat perplexing picture of higher inflation, slower growth, and higher unemployment than previously communicated. The median FOMC expectation on the year-over-year core consumption deflator inflation rate is now higher for 2022, 23, and 24, despite recent evidence that inflation is cooling. Its other revisions also tell us the Fed sees a need for below-trend growth and a pickup in unemployment to meet their objectives, but that the committee still sees potential for a soft landing. Interestingly, futures markets disagree with the Fed's own forecasts of the federal funds rate for 2023. Despite Powell pushing back on the idea of rate cuts, the futures market have priced in rate cuts for the second half of 2023, reflecting the concern toward the risk that too aggressive Fed action could tip the economy into recession. 2022 in some ways was a forest fire for global markets, prompting a global reset in valuations that spared few asset classes. However, the important silver lining of a forest fire is that it paves the way for a whole new slate of vegetation to come to life. So as investors assess positioning in the new year, it's important to take a new lens to investing and assess not only the remaining risks on the horizon, but also the new menu of investment opportunities in the aftermath of last year's performance. Here we show 10 of the major asset classes and styles and their valuations expressed as z-scores versus their respective 20-year history. The z-score measures the distance from the average, so a z-score of 0.85% is 0.85 standard deviations above the mean or average, and negative 1.52% is how far below the average 2022 was. This allows us to illustrate how normal or abnormal current valuations are. Compared to the end of 2021, most asset classes are considerably cheaper today. In particular, the sharp rises in yields have left U.S. Treasury and core fixed income about one standard deviation cheap. While the other asset classes may not be as cheap versus their own history, we have come off some extremely lofty valuations from the start of 2022. This is not to say the year ahead won't face further challenges in the market, but with inflation receding and a Fed pivot forthcoming, the worst of the wildfire is likely done, and with careful risk management, there is plenty of opportunity for investors on sale as we start the year. What was particularly unique about the performance in 2022 was that a bear market in stocks was accentuated by a bear market in bonds. A portfolio was 60% invested in the S&P 500 and 40% in the Bloomberg U.S. Aggregate Bond Index fell 13% in 2022, the second worst year for a 60-40 portfolio since 1974. Rising inflation combined with rising yields contributed to deep sell-offs in both stocks and bonds. However, the negative correlation between stocks and bonds is still overwhelmingly the norm, with most drawdowns in equity markets offset by gains in fixed income. Moreover, as investors assess performance going forward, large drawdowns in both stocks and bonds have never repeated themselves in the next year. Indeed, past years of underperformance were often followed by years of strong performance. Looking at home sales, the national average home price was 9.2% higher year over year as of October 2022, compared to Seattle, which was up only 4.5%. Despite the recent stall in home prices, affordability is still very low since the pandemic struck. Loan requirements have softened over the last couple of years with decreasing credit scores at mortgage origination. Still a big difference from the average credit score prior to the great financial crisis of 2008. The National Bureau of Economic Research, or NBER, determines whether or not we are in recession. They have no fixed rule about what measures contribute information to the process or how they are weighted in their decisions. However, in recent decades, the two measures that they have put the most weight on are real personal income less transfers and non-farm payroll employment. Employment data are favorable, while real wholesale plus retail sales saw a significant slowdown in November, as well as a slowdown in industrial production. So let's keep monitoring this slide quarterly to gauge where we are at with the risk of recession. 2022 was a very disappointing year in markets. This drove consumer sentiment down to its lowest level on record in June, and it has only staged a modest rebound since then. When investors feel gloomy or worried about the outlook, their natural tendency is to sell risk assets in general and stocks in particular. However, history suggests that trying to time markets in this way is a mistake. This slide shows the University of Michigan Index of Consumer Sentiment stretching back over the past 50 years with 8 distinct peaks and troughs noted. We also show how much the S&P 500 went up or down in the 12 months following the peaks or troughs. On average, buying at a confidence peak yielded a return of 4.1%, while buying at a trough returned 24.9%. This is not to argue that U.S. stocks will return anything like a 24.9% return in the year ahead. Many other factors will determine that outcome. However, it does suggest that in planning for 2023 and beyond, investors should focus on what they own and valuations rather than when to buy and sell and how they feel about the world. Thank you very much for making it all the way through this quarter's review. As always, please feel free to reach out to me to review this and more.